In stark contrast to 2016, the midterm elections followed the script in which the two chambers of Congress are now split. You have a Democratic House and a Republican Senate. Now, this has been consensus expectations for the last 6 months, so the implications are largely priced in. This means that the market's reaction is likely to be more muted than had one party emerged victorious. Now, let's look at this from a trade perspective. Now, importantly, without budget reconciliation available for the Republicans, no additional stimulus is likely to come into the U.S. economy over the next couple of years to offset future tariffs. Now, this could soften the administration's stance, and ultimately, agreements may be forged with the Chinese and the European Union. Now, although this is not our base case scenario, the probabilities have increased that this could come to fruition, which means that the international markets may catch a bid at the expense of the U.S. markets. Now, healthcare had arguably the most to gain or lose based on this election outcome. Importantly, with a split Congress, there's going to be no major changes to the ACA, better known as Obamacare, or drug price control. Now, we think this should be viewed positively by market participants for biopharmaceuticals. Biopharmaceuticals could re-rate higher because the threat of drug price control is likely off the table for the next couple of years. We also think there could be a catalyst for higher M&A activity within biopharmaceuticals, as healthcare has the most overseas foreign unremitted foreign earnings as a percentage of their market cap, and if this near-term risk is off the table, we think that could mean higher M&A activity for pharmaceutical companies and their biotech brethren. Moving over to deregulation. We think deregulation will slow, but it's not going to come to a halt, because we do believe that although investigations will increase into the executive branch and government agencies instituted by the House of Representatives, the GOP still leads the Senate, and they can continue to confirm appointments and move forward the deregulatory agenda. The continuation of deregulation is going to be good for business confidence. If business confidence is high, that means increased hiring and potentially increased capital expenditures, both of which have a multiplier effect on the economy. Also, the two sectors that have benefited the most from deregulation could catch a bid, which is financials and energy, and also we think select communication services names could re-rate higher because net neutrality is not going to be repealed. Now, we think volatility will likely increase once we get to the time of year where government shutdowns and debt ceiling raises need to take place, similar to what we saw in 2011 and 2013. Importantly, though, we do think new deals can be forged, and the Democrats will like to have higher domestic spending, and the Republicans will like to have higher defense spending. And I think that's a way that we can get through these potential hurdles in 2019 and 20. But you could start to see defense weakness and as we move up to the 2020 presidential election. Now, although this scenario is largely priced in from the markets, it's important to look at this from a longer-term lens. Now, if you look at the 1 year following the midterm election, since 1950, you've had 17 years of positive market returns, so 100% hit rate. The average return in that 1 year following the midterm election has been 15.3%. And a big reason for this is that the third year of a presidential cycle has not seen a recession in the post-World War II era. So with the U.S. economy still strong, earnings above trend and revenue growth above trend, and also margins continuing to expand, we think that the market will continue to move forward throughout the course of next year. Let's not forget that buyback activity is starting to ramp up as companies exit their blackout periods for third quarter earnings. We believe that the global economy is bottoming and starting to move higher, and they're going to get a big boost from Chinese stimulus, as the Chinese have been stimulating from both a monetary and a fiscal perspective. The last time that the Chinese stimulated this markets to this effect was 2015 and 16, and sure enough, the global economy roared higher in 2016 and 17, and we think that this, coupled with a U.S. economy that's still healthy, bodes well for risk assets over the course of 2019.